We want to talk about some of the other concerns in the economy and the market. So let's bring in Taimur Baig. He is the director, chief economist, and managing director at DBS Group Research. Really good to see you, Taimur. Let's talk about the Bank of Japan first, because that was a key concern in the past 24 hours after the shock move from the central bank. Do you see this as any form of a dovish or departure from the dovish tilt of the central bank?
Good morning, everyone. Two things. One is the technical aspect of untenability of the previous framework of yield curve control. Second is the fear of inflation creeping through a weak yen. So let's talk about the first, I think, which is what Governor Kuroda wants us to focus on, which is that technically speaking, keeping yield curve the way it was, targeting 0.25% at the 10-year, and was becoming a bit untenable. They were buying way too many bonds. The market was becoming distorted. And it was high time, as he had pointed out to the prime minister in his recent meetings, that some adjustments had to be made. So that's a technical adjustment. It's about monetary operations. It's about making the yield curve look a little more realistic. But the second part, which I think is what the market is trying to digest, is if a country that has struggled with deflation for greater part of a decade or two is getting worried about inflation, what does it mean for the whole world economy in 2023? Is it the case that the weak yen and the high cost of import is beginning to affect profitability, is beginning to cloud the inflation outlook, and is going to create significant consternation among the Japanese public? Could those things be the motivating factor of Governor Kuroda, who we all thought would not touch this issue in his tenure, leave it to a successor, has to grapple with? So initial reaction from the market was the latter, that if this is the problem, inflation is the issue that is motivating the Bank of Japan, what does it mean for the Fed and what does it mean for everybody else, which is why you saw rather sort of risk-off reaction to that, with the yields in the U.S. rising, the stock market futures selling off in the immediate aftermath of the announcement. Things have stabilized a bit in the market since then. I think the view is that it was a mixture of that first factor, technical reason, but also the second factor of inflation pass-through being a concern as well.
Okay, as we watch the inflation picture, not just in Japan, but globally, what is your sense of whether this latest move by the Bank of Japan opens the door for eventually abandoning of the yield curve control program?
It cannot go on forever. It is becoming very costly, both from the perspective of the central bank as well as from the overall monetary fiscal coordination between the Bank of Japan and the Ministry of Finance. If indeed we are going to see a gradual rise in inflation and inflation expectations, there's no need to do this, because the whole thing was done to bring back inflation to the Japanese economy. If they get it, they can declare victory and move on. So from that perspective, it is fine. I think what any central bank, and the Bank of Japan is no exception, would want to achieve is do that transition in an orderly manner. Yesterday's developments were not orderly. It was not part of Bank of Japan's forward guidance. And once you start saying, I'm going to adjust the targeted yield by this much, there is no credibility left. You could do another 25 basis points 2 months later. You did it already. So that's the issue that I'm sort of also taken aback by, along with my peers in the markets, that they did it so late in the day. And clearly that means that, their backs were against the wall. This is the first salvo of an eventual transition to a more normal monetary policy framework, no doubt.
Okay, can you help us also look at the extent in which this brings Japanese investors back home, and what does this mean for the demand for U.S. treasuries? I mean, you talk about how there's some stability returning to the markets this morning, but in the longer run, where do you see things headed?
These are very important considerations. Bank of Japan or the Japanese investors, let's put it that way, are very large purchasers and therefore supporters of the U.S. Treasury market. If indeed their home bias returns as rates start going up domestically, that's a negative for U.S. bond yields, and which is why immediate knee-jerk reaction of the market was to start bidding up U.S. dollar Treasury yields. That is certainly a consideration one has to keep in mind. Let's also keep in mind that China is no longer that huge buyer of U.S. treasuries that it used to be. What has happened through the course of 2022 is that petroleum exporting economies have incurred such large surpluses that they have become a very big supporter of the U.S. Treasury market. So it's not just that the Japanese investors are the only game in town to support the U.S. Treasury market. There are others as well, but Japan is an important player, and that matters. So one would have to be a little more cautious about the U.S. Treasury outlook if such an important customer starts having alternative options domestically.
Taimur, I wish we had more time with you, but just very quickly, a final question before I have to let you go. When you talk about China as well, you look at the reopening. Do you think we're going to see a stock market rebound in the first quarter of next year?
Avril, my narrative on China is that they are like everybody else. Some countries made mistakes during the pandemic, some countries did not. All ended up in a post pandemic setup, all ended up with revenge buying and revenge travel dynamic sooner or later. China will be no exception. They're struggling to get out of it now. They will get out of it just like we all have.
Okay, Taimur, we'll leave it there for today. Thanks so much for sharing your analysis with us. Taimur Baig is Director, Chief Economist, and Managing Director for DBS Group Research.